what ended up happening for them is they kept getting approached by strategics. And I think a lot of small business owners can relate to this these days. 10 years ago, this wasn't the case, but now people get calls all the time. Somebody's constantly saying, hey, do you want to talk about us investing in you? Do you want to talk about selling your business? And what I hear most often from sellers is they're sick of these phone calls because it's distracting.
Welcome everyone to the Local Service Mastery Podcast. Today I have a very special guest with me, Emily Holdman, who's a managing director at Permanent Equity. And not just that, I think that Emily, along with her partner Brent, has one of the most important podcasts you as service business owners could listen to out in the interweb. To be honest, this is just mind-blowing that this stuff is out there for free. Emily, thank you so much for being here.
Oh, thank you for having me. That was a nice plug. Yeah, the Permanent Podcast, we tried to be as open as we can.
Listen, my only feedback on this is that with Audible, there's an issue that, like, I know you made it like for small segments, and every time I need to go all the way back to the beginning, and I'm trying to listen to it like for 15, 20 minutes before going to sleep or whatever. And once you press that 15, 20 minutes, it's not like on an audiobook that it just goes directly to the next part. So it goes to the latest podcast
episode
that you made. Yes, exactly.
We do.
Exactly.
That's a good point. We probably need to re-release the messy marketplace component of it. So yes, what you're talking about is the first section of our podcast is an audio version of Brent and I talking through a book that we wrote a few years back on selling a business, and it's called The Messy Marketplace. And so that was the first iteration of our podcast. Is he and I sitting there, he read the book, and then we would kind of riff on why did we write the section the way that we did and other considerations that people should be thinking about as they, read through it. But we did it, pretty old school and just recorded podcasts. So it's not technically an audiobook, but we could totally make it into one. And I heed the comments. So I will actually see if we can do something about that here in the coming weeks.
I think, to be honest, when listening to you guys, I would think that you guys are from PBS or something. I wouldn't think that you're, investors, because you're so professional. And, me, just as part of our work, doing podcasts, interviews and stuff like that, you have an ear for professionalism, and you do the way you describe it and the way you interact between one another is just phenomenal.
Oh, that's very kind. Thank you. Yeah, we both like to talk a lot, so and we've worked together for a long time, so I think that plays into it. But it really was actually in this room, us just sitting there for a couple of days, just walking through each part of the book. But that was after writing a book, which was a labor of love and took a lot longer. So hopefully that came through.
Yes, it definitely did. So maybe we'll start with your journey. I'm curious to know. I heard on other podcasts how Brent got his how he got started in investing in businesses, but I'd love to hear about your journey, how you get involved in this exciting venture.
Yeah, so he has a non-traditional journey, as do I. And so the short version of it is I went to school for journalism and economics. I've always liked numbers and writing. And so I just kind of studied what I thought was interesting and intended to go into publicity and advertising. And that was what I took internships in, and that was my first job out of school. And I thought I was going to have, a marketing and advertising oriented career. I was in California and was originally from the Midwest, had a boyfriend who's now my husband, who is here in Missouri, and was looking for a reason to come back to the area. And this was in 2009, so during the Great Recession. So weird time to be looking to switch jobs and looking for a career generally. And I found an
especially in
article
the Midwest.
about exactly, especially in the Midwest. And I had gone to Mizzou, so Columbia was a version of home for me. And so I found an article about a guy who had invested in specific technology related to commercial production for ads. Television ads at the time. And so I read about it and thought it was interesting based on I was in film advertising at the time, and so was familiar with the technology. And so I reached out to him and found him on LinkedIn. Back then, there were about 50,000 people on LinkedIn, and Brent and I happened to be two of them. And so I reached out, and at that point, he could accept a cold message and was willing to do so. And so we had an email exchange for a couple of days, and then I came in, and he didn't have a role for me. So to give him the credit, there wasn't an open position I was applying for. I just was interested in what he was doing. And we sat down, and I tell him to this day, he grilled me for like 4 hours on just like everything under the sun. How, just taste making. What do you see about the world? Like, what brands do you like? Kind of very broad ranging. And I asked him a lot of questions about what his visions were. And, as energetic as he seems now, at the time he was in his mid-20s and he was even more energetic. And so I was drawn to the ideas and the energy. And that's when we started working together. So he was willing to create a role for me at the agency that he had founded. And that's how we started working together. And that was the same year that he bought his first small business, which was Media Cross, which we still own today. And they recruit physicians and nurses into the National Institutes of Health and branches of the military, and also use those skill sets of understanding veterans and recruiting to help higher ed institutions and some other brands. So in that, it was an interesting time to join his team. And I got to see sort of how he was building brands, but also what the opportunity was that we eventually began to focus on, which is the lower middle market and getting involved in smaller companies that have been around for a while, but want help in scaling and stewardship long term.
That's interesting. And you join in basically as an employee, and you grew up to become an equal partner, if I'm not mistaken, right?
Not an equal partner, yes. So, but I am a partner in the firm. And to the extent that, so from that point forward, Brent initially focused on the company that we had acquired. I stayed focused on some of the other entities that we had operating at the time. And then as we clarified more and more on how we were going to continue to build the business, my role evolved into focusing on new opportunities. So for the past 11, 12 years, I have been what you would consider the front end of our organization. So I'm the one who speaks most often to owners and intermediaries about what they're trying to accomplish, how we can be helpful or not. And so a lot of it is trying to problem solve around why people are having conversations and what they understand to be true about investors versus what we do, and then figuring out if we can be a good partner. So that's the area of the firm that I stay most focused on. And then obviously, given my background, our content generation as well is kind of in my wheelhouse. So that we now have a full team devoted to that. But that effort has been core to my involvement as well.
That's beautiful. That's beautiful. And in terms of, first of all, the vision, was the vision there from the beginning when you met Brent for the first time, or is this something that evolved over the years?
No, I mean, I think you're always reconciling, right, with your experience and updating your thinking. And I think Brent's phenomenal at doing that. But as a team, we were doing that regularly as well. And so he's always been drawn to ideas and I would say first principles thinking. So, what things are versus what they could be, and ways to get there that may not be obvious based on traditional streams or process. And so with that, when we made our first investment, we were able to look at the way that the business had been operating, which was based on one individual's preferences, and say, there's a lot about this that's super interesting, but there were people inside the organization who had other ideas on things that they wanted to see championed, as well as things that we had learned through our own experience, especially on the technology side and some other elements of, being younger and less tech averse than some of the people that had been with the organization for a long time. And so it was a really great opportunity to sort of sit down and say, what can we prioritize and who can bring what to the table? And I think we've done that in every situation since. So it's always just a conversation around how quickly can we, find opportunities to advance our objectives. But in terms of thinking about like what was being built, I mean, Brent would say this too, but like we had no idea where we would be in 5 years, let alone 15. And it certainly, I think, fortunately turned out better than we could have hoped and probably better than we deserve. And so in that way, we've just always stayed focused on doing the work and learning while we're going and just seeing, kind of where we end up. And we've had lots of great people partner with us along the way to do that.
And right now your focus is like what companies are you currently investing in or focusing mostly on the investment side?
So we're a pretty unique firm, right? So in that way, we are an approach-driven firm is the way I would describe it. So you'll meet a lot of firms that will invest in HVAC businesses, right? And they'll say we have a particular theme that's tied to an industry. And you'll meet other firms who will say we do this one specific type of financial product. We are not focused on either version that looks like that. Instead, what we say is we're an approach-driven firm. So we're far more interested in the families that own the businesses and in the teams that operate them and what serves them best. In general, our posture is that we will never know an industry, any individual industry, better than the people who work in it every day. So our role is not to have some grand plan about how to improve HVAC as an example, right? Our grand plan is that there are very smart people who have spent oftentimes decades carving out a niche and a reputation in an industry and a position that is worth defending and expanding. And our role is to help them do that, right? And so we are a long-term steward of the businesses that we get involved in. And we do so with an operational approach. So most private equity firms will use a lot of leverage to close a transaction. We avoid leverage altogether when it comes to transactions. So we're not changing the way that a company's balance sheet looks, and instead are focused on what allows for cultural continuity, operational continuity, and just keeping a good thing going. And then as we move forward, like I said, constantly having conversations about what can we do more of that advances our objectives. And that can be a wide range of things. Sometimes it's just letting things operate as they are. And sometimes it's, integrating new technology, hiring people, entering a new market. There's a variety of different things that you can do, right? But our focus is on that long-term stewardship model.
Right. But still, I'm sure that there is a wide range of different companies. For instance, tech companies is different than service companies. Companies under $1 million is different than companies who are doing over 10 million. Do you have like a sweet spot that this is what you're focused on?
This is what's interesting, right? So we last year we did 2 transactions. One was a software company with 2 guys in their 30s. And it's a relatively small company. It's been around for 5 years. And they're focused on the marketing technology space and integrating with various APIs and ERP systems and helping people to advance, their ad optimization online. The other deal we did was a company that's over 40 years old in residential fencing that's doing, almost $90 million in revenue, has over 100 employees, and is a much different business all around, right? And in both situations, it was because of, again, the people, what they were trying to accomplish, and how they were looking at the future of the organization, and far less about the business industry or sort of, or its scale either, right? It's just, are we the right type of steward for the model? So within our portfolio, you'll see everything from aerospace parts distribution to various types of manufacturing to luxury consumer services. It is really wide ranging, and that's because we have to understand the business model, feel like we can steward it, and believe that it will exist in 30 years because that's how long our fund model is. But to the extent that we'll look at anything, it's pretty wide ranging for a reason, because we think that oftentimes we're aligning more so with the people than with anything else.
Mm-hmm. Mm-hmm. That's funny that you mentioned the tech company. Because I would think, and I've had another private equity partner on a podcast, and when we talked, it was very clear on what type of businesses they invest in. Like home services, making let's say $2 to $10 million a year in EBITDA. So it's kind of and these companies that been around for like 20, 30 years, and the incentive of the owner want to cash out, want to spend time with the grandkids or whatnot. And so it makes sense. But when you think of younger folks who are doing tech, I'm curious to know what's the incentive of going into a private equity company versus going into just a traditional venture capital firm that can help them grow into the next round and so on.
Sure. So think about, I sort of divide it up by what are you trying to accomplish, right? So if you're going to raise venture money, there's an expectation of a certain magnitude that you're going to reach, right? And you're going to reach it one way or another because that's how the firms are set up to achieve their return model. And so that's going to, attract a certain type of entrepreneur and a certain type of business model. These guys would be what you would consider bootstrappers from an entrepreneurial standpoint. So they had never needed to take outside money because they were cash flowing from day one. Cash flow considerations are incredibly important to any investor. And so figuring out exactly when and how you're going to achieve a return is, kind of key to how you underwrite a deal. So in that way, they were cash flow positive from the beginning and really never had to take on investment. What ended up happening for them is they kept getting approached by strategics. And I think a lot of small business owners can relate to this these days. 10 years ago, this wasn't the case, but now people get calls all the time. Somebody's constantly saying, hey, do you want to talk about us investing in you? Do you want to talk about selling your business? And what I hear most often from sellers is they're sick of these phone calls because it's distracting and you really don't know how to differentiate who's asking for what or who's going to be able to help you with what. And they were experiencing the same thing, had several strategics who had reached out, and all of them were reaching out in the way of saying, hey, you are a perfect fit to be added on to our business, which is why they're considered strategic, right? And so when that's the case, you have to know that your priorities are going to take second fiddle to the priorities of the larger organization that you're going to be combined with. So it's no longer just your business. It's going to be the ambitions and goals of another business that are going to have to be compromised with, right? So that was a pretty big component for them. And then the other piece was materially, they're in Duluth, Minnesota. And the two founders are from Duluth and they love living there. And they had been able to recruit a really great team into their office there. And they're, a tech firm, but they all come into the office because they enjoy each other's company. And every firm that they talked with on a strategic basis said that as a component of the investment that they were going to move them because of access to talent. And so they were going to either need to move to Denver or Chicago, a couple of other what you would consider sort of mid to top tier cities, right? With the intent that, look, that's just what happens when you're a software business and you want to get bigger. And they didn't really like that answer. They really love Duluth and they want to build a world-class business based there. And with the idea that they wanted to build the business that best serves its customers, not necessarily that's optimizing for a certain scale or a certain type of model as it continues to build. And so very focused on bottom line return, right? And not just adding revenue to add scale. And all of those elements led them to say, these are the people that are reaching out to us, but maybe we want to reach out to a few groups just to see, what our options are and put ourselves in a place to be on the offense rather than the defense, right? Because that's what ends up happening is when you're constantly being bombarded with phone calls, you're like on the defense, just trying to deal with all of the inbound interest. And so they reached out to a few firms, and that's when we got to know them. Our posture on the business as a whole is that they were fully capable based on their passion for and understanding of the opportunity set to recruit people to Duluth to continue to build out a business base there. We were fully supportive of that. And that the model is such that they can kind of scale in a variety of different ways. It's a very interesting business, both based on the fact that they can work with really small Amazon sellers all the way up to pretty big brands with multiple branches and a lot of complexity to how they spend marketing dollars. And so being able to focus on that wide of a breadth, they were going to need to prioritize, right, how they were going to continue to scale the business. And that was going to then determine how they were going to scale their team in terms of client service layers and a bunch of other things. And so that's what we have partnered to focus on, is to build the business according to the priorities that they believe in and that we also agree with, right? And so again, they're leading the vision for the business within, their industry, but it makes sense to us and it's something that we can get on board with. And we know client service scaling, how to incentivize sales teams, those types of things. And so we're partnered to continue to grow in that way. And now they're on the offense and they don't have to worry about all this like inbound interest and, who takes what kind of money and what are we trying to do. And frankly, they never needed the money. It was more about strategically what they were trying to accomplish and in what window of time. So that's it's a perfectly viable question that you asked, but it's kind of one of those things that it's completely situational as to, what your opportunity cost is to create partnerships. If you just need a partner because you quote unquote need money, most often, we're not going to be the right fit for you, right? And in most cases, if you need money, you often don't have the best options. So people who are proactive about having the conversations earlier and in situations where they still have a fair amount of optionality, in my experience, do better in terms of, figuring out the option pool they're most attracted to and the reasons for doing that, and oftentimes create better post-close outcomes for sure.
Right, definitely. And in terms of the way you structured your company, you mentioned something about the 30-year goal, or what was it? A
30-year fund. Mm-hmm.
Yeah.
Yep. So, so this was Brent's brainchild in combination with some of the investors who had reached out to us. So we had been writing about our operational experience for a long time, and sort of took some inspiration actually from venture capital firms in being transparent, right? And we had not experienced private equity being particularly transparent, and we thought that people should better understand sort of the options and how things generally work. And as we did that, what we didn't realize is that there were some investors who were also paying attention to it. And so they reached out and said, under what conditions would you all take outside capital? And the luxury up until that point was we were using internal money. And largely Brent's capital at the time. And with that, we had the luxury of making decisions as we saw fit, right? We weren't urgently trying to put capital to work and make investments. We also didn't need to sell anything because we believed with conviction in the future of what we had invested in. And so we were in a really good position. And so as soon as you take other people's money, there's sort of like the the line of, you make different decisions when you have other people's money, right? And so with that, we did not want to make other people oriented decisions. And so the traditional model for private equity is generally a 2% management fee, 20% on the carry, and a 10-year fund. That's kind of the average, right? So you buy stuff for 3 years, operate it for 3 years, and then sell everything over the next 3 years, and then the fund is over. That model did not sound great for us, right? So we didn't like the 2% management fee, because when people are paying you 2% on all the capital that you have raised, they expect you to do things. And so with that, what we wanted to do is,
you mean, in the Hamptons in the summer?
I mean, I think that's one version of it that certainly gets the caricature. But the other version of it is, and honestly, this is happening right now in the current markets, is there's still capital to be put to work, but finding good deals to put it to work on is a challenge in certain environments. And because they're incentivized to do something, because you're paying them money anyway, there's this natural tendency for the firms to take action and make an investment, whether or not it's the right time or the right situation, or they are the best fit. And we just never wanted to do that. We only wanted to do deals when we felt convicted about them. And we've always invested with no intention of selling. And so the idea of doing a 10-year fund never worked for us. So we had to go back to a first principles basis to figure out a fund model that would work for us, and still made sense for LPs. So the fund model we have is an initial 27-year term, and then 3 one-year options. And then at year 30, the LP base can vote for it to continue even beyond that. So when I talk to sellers, I say it's a generational partner for the business. And in that, we have a lot of time and a lot of optionality on how we grow and in what ways. And so it gives us just the ultimate opportunity cost. So it doesn't mean that we would never sell a business if it's in the best interest of the business. But we are not going to be a forced seller in years 7, 8, 9, 10, right? We can continue to hold as we see fit. And since we don't take a management fee, we only do deals when they do make sense to us. So we have a 10-year investment period on our funds, which also gives us the luxury, if you will, to be able to kind of ride out different macroeconomic environments and make deals when it makes sense.
Mm-hmm. So you're only can you repeat, like, what do you take from LPs? Because I think that point is something that I wanna touch on
Sure.
a little bit more.
Yeah. So from a clarity standpoint, our fund model is that we take 0% upfront, and then we have a tiered carry, which is based on cash IRR. So you can think about the way that we operate companies. The closest relevant example is a dynastic family, the way that they would operate companies that they own, right? So every year you tend to make some level of distribution out of the companies that you're operating, but you're not starving them of resources, right? You're making a dividend of some kind, but you're not starving the companies of resources, because that would decrease their terminal value, right? So you're not trying to sort of like let companies naturally die off either. And so there's definitely ongoing conversations about reinvestment back into the organizations, and then also distributions to be made up and out of the companies. And so what's cool about it is that, usually the way private equity funds work is they use a ton of leverage up front, because that is how they help pay for the deal. And they're able to buy bigger assets as a result. But everyone gets paid when they sell it, right? Because during the time that they own it, basically any amount of free cash flow that's available is going to service the debt, because they maxed out the debt to make the purchase. And so with that, they wait until the end to get paid, and everybody gets paid at that point, and whatever the magnitude of the return is final. Our approach is that we take annual distributions. Not every company contributes to every distribution because they may have compelling reinvestment opportunities. And also it may not be the best time for them, right, to do so. So we're, sort of operator first mentality around don't starve yourself of resources if you need the resources. But if you have excess cash and you've done well, then there's an opportunity to distribute profit. And that allows for investors to be able to realize a return in real time while still having equity in an asset that at some point can be realized, right? And so it's a complementary system that allows for us to be able to then hold a much longer period and not have to return the capital in order for the investors to feel like they can have a return.
Right. And the investors, they invest excuse me, they invest in basically in a fund, and you pull into the fund like multiple different type of companies that you choose, basically, right?
Right. So we have two funds that we have raised. The first one would be considered fully deployed. So meaning that we are not investing out of that fund anymore. That fund was raised in 2017. And so, yes, it was a collection of families and high net worth individuals that the capital was raised from. And it was a $50 million fund. And so that fund continues to operate today. Again, we've never sold a business. So everything we've invested in, we still own. But they make regular distributions. And then our second fund we raised in 2019, and that was a significantly larger fund, but the same structure. So it's a $300 million fund. It's anchored by two endowments. And then there are also families involved in that fund as well. And so, again, for them, it makes sense because it allows for them to get liquidity on an annual basis, but still to, have the mentality of owning private assets in value propositions that we collectively believe will exist for decades to come. And so it's, every fund is different. In our first fund, we have a luxury services company, we have an aerospace company, we have a manufacturer, and we have a construction company. There are 4 companies in the fund. None of them are related, right? Which allows, it's sort of the luxury of like any sort of asset portfolio. If you think about it from an investor standpoint, it's one of those things that uncorrelated assets mean that one year, one company can do phenomenally, right? And while another one heavily reinvests, and that works well. And then the next year it can completely reverse and that works well, right? And so... Yeah. Yes, exactly. And so, having them not be related is actually, we believe, helpful. Certainly we have, opportunities for our CEOs and operators to get together and share best practices and those types of things. But we don't really acquire things based on them being synergistic. So like the example you gave earlier of, firms that exclusively focus on one type of business, right? Oftentimes they're running what we would refer to as a roll-up strategy. So they're going to buy a bunch of related things, put them together, even loosely, and then sell whatever that combined asset is for a higher valuation because both you've added all of those aggregate, incomes together, but also because you can get a higher multiple ostensibly off of more assets, right? And so that's one way to, build a portfolio. Ours is fundamentally focusing on what makes that business great, and continuing to build that business in ways that are unique to its opportunity set, and using the luxury of time to our advantage, right? So what can a roll-up not do? A roll-up can't focus on something that's going to take 5 years to build, because in 5 years, that business will be sold, right? And any one business within that roll-up, if they have a great market position within one locale, it doesn't matter because the whole point of a roll-up is to diversify locations and to diversify across, a broader set of services. Whereas we can say, no, we want to be the best at this one thing in this region and have very high conviction and focus on that if we think that's the best version of the business, right? And so again, it's sort of like when you have sort of industry specific theses, you can get pretty focused on things that are tied to the model under which you raised capital. So I refer to it as like capital behavior. Like however you raise the money, it has to behave a certain way because there are expectations and requirements tied to that capital. And so if the capital was raised to be returned within a 10-year period, sometimes even a 7-year period, it's going to behave a very specific way, regardless of whether that is quote unquote best for the business.
Right. So what type of behavior do the LPs expect? Is it more like a S&P 500 or real estate where you get like 8 to 10% a year return? Is it like, I don't know if these are like public numbers that you guys share or not, but just like roughly speaking, is it more on this side, or is it something where it's more closer to the venture capital where you get nothing at the beginning, but then you can get a really high multiple on your money once an exit occurs?
Once it's exit. Yeah. So we focus on businesses based on their operating behavior. We do not focus on, who we're going to sell it to for highest value. So you will see some value propositions represented in our portfolio that, it may be more difficult to find someone to sell it to later. And that can be because it has, cyclical attributes or customer concentration or other things that make it less attractive to the broader investor set, but it's a really damn good business, right? And so when you have those, you think about like the individual entrepreneur who does well by having high conviction about who they serve and how they serve them. Like those are the people that we want to partner with. And if it has a great exit potential, that's great. But we also want the business itself to be intrinsically healthy. And so what we mean by that is there should be free cash flow, right? And so we don't invest in businesses that are turnarounds or have not yet figured out product market fit in a way that they don't produce free cash flow. They have to produce free cash flow for us to be interested from the beginning. But the magnitude of that, both on a margin basis and an overall scale, can be widely flexible again, because we can see, how big the opportunity set is, how quickly it's growing.
Is the founder of the business, is he staying on at some capacity?
Sure.
How does that usually work? Are you becoming a majority owner of the business or minority?
Mm-hmm. So we focus on majority-oriented transactions because of our hold period. Most of the time, anyone we're partnering with doesn't have a longer time horizon than 30 years. And so for that reason, we want to be in the majority position, but we're flexible between 51 and 100%. So the software example I gave earlier, those guys have a super long runway too, and they wanted to keep a bunch of the economics. Again, the money wasn't necessarily their primary reason for doing a deal. And so in that way, we bought 51% of that business. And so in some deals, we'll buy just a very simple majority and move forward together. And we like that because that's a way for everybody to continue to build the business and share in those economics long term. But in other cases, we are solving for a succession issue and trying to steward a business long term for somebody who is looking to take steps away. So in our portfolio, we have 13 companies as of this moment, and 5 of those we do own outright. So we own 100% of them. And in each one of those situations, again, it was based on the people, right? The owners of the business were not necessarily the operators of the business at that point in time. And the owners were at an age and in a life circumstance in which they needed to fully remove themselves both from the cap table and any association with the business for personal reasons. And so when that makes sense, we can buy 100% 100% of a company. As operators listening to this, my advice would be that doing deals when you don't have to sell 100% gives you a much better opportunity set, because it's a risk sharing opportunity with anyone you are going to partner with. When you sell 100% of a business, the investor has to be that much more convicted that they can operate the business without you. And so it's a higher standard
investment.
Right. It's a higher standard that has to be reached, rather than something where you're willing to hold 20 or 30% for some period of time, and help to ensure, a smoother transition, and also just get to know each other, share institutional knowledge. And it also signals that you believe in the future of the business, right? So where possible, we think that the best deals are somewhere in that, kind of 70-30, 80-20, 60-40 range. But at either end, like, we're pretty flexible based on, if you're high conviction, we're happy to do a 51-49 deal. And if there's a circumstance by which the business just needs to be sold, if we believe we can steward it well, and there is institutional knowledge in the business, among other leaders outside of the owner, then we can also do a 100% deal.
Got it. Awesome. So I think that this marks like the first part of our conversation, which is like understanding a little bit about you and your fund and how you guys are operating. And on this second part, I want to share with you, first of all, what I do. I help home service business owners grow and scale their business into 7- and 8-figure companies by mastering lead generation, by learning how to do SEO and Google ads, Facebook ads, and so on, because as you probably know, one of their biggest challenges is acquiring new leads and new clients. And a lot of the marketing firms out there are as notorious as some of the private equity companies, right? So they don't have a good name for themselves. A lot of low quality work. A lot of people are outright scamming service business owners. And so you need, as a business owner, you need to master this. In my opinion, this is one of the two most important components. One is sales, and the other one is marketing. And I deal with a lot of, I would say, million and under companies where the owner is the main operator of the business. And I'm sure that a lot of our listeners are at that point where they're doing $200,000, $300,000, $500,000, $700,000 a year in their service business. The business is good, good profit margins, whether you're a locksmith, garage door service company, plumber, whatever, HVAC, whatever business that is. But they want to understand how to take it into their next step. And so that's my question to you, because you're seeing those success stories, those companies that you're able to acquire, and they're still operating without the owner who's necessarily heavily involved in the day-to-day operation. I'd love to hear some of your thoughts and some of your tips on how to build such a successful operation.
Sure. Oh man, I have a lot of stories on this topic. We invested in a swimming pool construction firm based in Phoenix, Arizona. It's the largest swimming pool construction firm in the country by volume. They build like 2,000 swimming pools a year just in Arizona. And when we invested, one of the things that they said was, we spend a lot on marketing, and we just wait for people to let us know that they're ready to build a pool. And what they meant is they spent a lot on radio advertising and some billboard advertising based on some relationships, to the tune of about $2 million a year. But they didn't have any tracking, right? And then they had a PPC firm that was industry specific that was buying Google AdWords on their behalf. And so we walked in and we said, okay, this is interesting. You guys are spending significantly compared to the size at the time on marketing. Let's see how well this is working, right? And several of us, again, had started in the ad world, and, so have an appreciation like you for, you want to understand the value of every lead. You want to understand how you're originating leads. And there are a couple of things that I would say were at play. So one is just that, when people who don't have a marketing background are making marketing related decisions, oftentimes they're getting sold based on fear, right? So it's sort of a fear-based sell of, hey, you don't understand Google AdWords. I do. So let me work this magic for you and you don't have to worry about it. Not understanding like whatever you're paying for, like we don't do in many other categories as operators, but for some reason in marketing, it works. I don't know why it works, but it tends to work particularly for smaller companies. And sometimes it's borderline predatory, right? So in this case, they were working with a PPC firm who was also working with all of their competitors in the market and operating one unified account on behalf of everyone, and no one could access their own information. So they owned the keywords. And so, depending on how much your listeners actually know about that marketplace, if you don't own the keyword and someone else is spending the money in an account you can't access, if you don't work with them anymore, then you don't have any of your background, right? None of your information. And if that same account is bidding on behalf of multiple URLs on the same keyword, you're bidding up the auction organically between yourselves, right? So basically, if everyone's building on Pool Builder Phoenix, and you're one pool builder and your competitor is the other pool builder, and you're both paying the same guy, you're both going to pay more because he's running the auction and you're both participating. And so it was this wild situation of just conflicting. It was bad. And so
they hold you hostage because at the end of the day, sorry to cut you off, Emily, but it just, it makes me like freaking furious because at the end of the day, they hold you hostage because, okay, you don't want to work with us? Go start from scratch. And so all of your data and everything that you've built so far, you'll be like, oh my God, how do I do all of this? I have no data. I have no idea how to do it. I need to now start looking for a new company without having anything to show for. And so, it's... And it's scary if that's a significant lead source for you, right? If you believe that to be a significant lead source, cutting it off like that can be pretty scary. We had confidence that we could build it up again on our own. And that's ultimately what we did. And my advice generally is if somebody is running an ad firm in that vein and they will hold you hostage, chances are if you go find somebody who organically creates it on your behalf individually, you will be better off. You may suffer short term, but it's not going to be a long-term issue for you. And you should never let someone do that. So that was one of the issues going on. Another issue was that they were spending money in a variety of different places that were untrackable at pretty significant amounts, hundreds of thousands of dollars. And when you do that, you just kind of have to organically believe that the people that walk in the door are good leads for you. But they had this issue with, they had bad internet traffic based on some early versions of like content marketing that people had done on their behalf. So like, enter your email to download 10 reasons why you should build a pool or something like that. Yeah, like a lead magnet.
So yeah. And so, the lead quality on that is terrible because you're getting an email for somebody who didn't actually say, I want to build a pool. They just downloaded a piece of information, right? So, again, by a scoring standpoint, you would think like, well, that's not worth circulating to your sales team because it's probably not a lead worth calling yet, right? It may turn into one, but based on that indication, it's just an interaction on your website. Well, they didn't have that distinction in terms of assessing lead quality and figuring out how to funnel people into interactions that made sense based on how, substantive of an indication they had given about a purchase intent. And so with that, we said, okay, we need to actually be able to track leads. And we need a site that gives people the ability to signal with varying levels of strength what they're interested in doing, right? Including, distinctions between, are you trying to contact service? Are you trying to contact remodeling versus actually building a pool? So those are the types of distinctions that they were kind of lacking in terms of the way that the website was set up originally. So we were looking for ways to improve upon that, but also because of the magnitude of spending, it was sort of chaotic. So we ended up actually reducing spending the first year, just so that there was less going on and we could pay attention to where we placed things, how they were tracked, and just start to assess a lead cost measure, and also a lead quality measure based on how they came in and what they indicated. And so we did that, and it's not rocket science, but it is incredibly helpful if you feel like you don't know where your leads are coming from and you don't know why you're spending what money. Just to take it down a notch and then start to assign that. So we ended up putting somebody in place who was just a lead quarterback. And that person's responsibility was to know the origination source and then what to do with that lead based on what they said. And that was experimental for a while, right? So we would say, okay, here's what they indicated. And we did a lot of testing around form length and types of questions. So as you can imagine, and this may be relevant to landscapers in particular, but for pools, one of the things is how much do they already know about the pool that they want to build, right? So that includes design and size and features and other things. So we had this crazy long form that we tested that had, I think, 37 questions on it. So you can imagine it takes a few minutes to input. Yeah. No, it takes a few minutes to input all your information on. It was the highest converting form that we had, right? But you can understand why. If somebody is at that juncture around making a decision, they're ready to buy a pool, right? They've already done their research. Yeah. They're just trying to figure out who is going to best serve them. And it was incredibly helpful for the salesperson because in advance of talking to that potential customer, they now had a tremendous amount more information off of which to build the conversation. So all of that matters in terms of how we think about, how you build that funnel, right? But my overall, assessment of when we walked in the door was we were spending a lot of money and we didn't know why we were getting the leads that we had. So if you fast forward about 18 months from that period, again, lead generation is always iterative. The way that company generates leads now is different than the way that they generated leads in that first 18-month period. And it should be. And when you should dedicate more resources that can focus on that element of the business. But even within that first 18 months, we had, I believe it was about 4 times the lead flow, spending about 60% of what they had previously been spending. And so when you can make those kinds of optimization changes, obviously on a profitability standpoint, it's incredibly worthwhile. But in terms of increasing your opportunity generation, obviously super valuable on that side as well. So in general, it's an area of business, when we're talking to a business that is consumer facing specifically, it's one of the first things we dig into is just understanding where they are in a level of sophistication on that side. And the cool part is you can always level it up, right? There's always more to do. There's always more to test. And when you get to a certain size and scale, you can run, grander experiments, right? That can allow for you to, make leaps, if you will, instead of just gradual improvement.
And it's not rocket science. I think that's the most important thing. And a lot of the contractors and the home service business owners who have this initial fear is they think, oh, I've never grown up with a computer. I'm more of a field guy, whatever it is, whatever the story they tell themselves. Yeah, you might have a steeper learning curve, but it doesn't mean that you won't be able to figure it out, especially if you're taking someone on that shows you step by step how the whole process works. And so even if later on, whether you're hiring an outside marketing agency, a virtual assistant, which is what we advocate for, or a person in-house to deal with your marketing efforts, that's it. No one can fool you around anymore. No one can sell you just air because of that fear of, oh, you're going to miss out or whatever it is. So yeah, I think it's vital for every business owner to know that. And
it's funny.
I want to understand. Sorry, go ahead.
Well, I was going to say, just to stop you there for a second, the funny thing that we hear sometimes is we'll talk to owners who will tell us, sort of with pride that they've never had to spend on marketing. And that's sort of the inverse of what you're talking about, right? Where they just believe that, well, we've done so well with referrals that we've never had to advertise ourselves. And it's a really interesting element of sort of an operator's philosophy, because referral-based business is phenomenal, right? Nobody doubts that. But if you haven't flexed how to continue to increase your opportunity set by spending at least some amount of money, you also have deprived yourself of better understanding your market, right? And you are relying solely on those connections. And if for some reason those start to move away, like if you're in a transient location where people move away really quickly, or if the market dynamics start to change, it's actually a pretty big embedded risk just to rely on referral-based business. So we have really interesting conversations with potential sellers as well on that front, that there's absolutely nothing but pride if you're able to have a substantial referral-based business. But making the business solely rely on that indicates that you probably have an opportunity to reinvest in marketing that you have not taken yet, right? And you should. Absolutely. It doesn't mean that you personally have to do it, but somebody should.
Absolutely. Now, the other thing that I feel like a lot of the business owners that I work with struggle with is they feel like everything is on their shoulders. If they won't do the job, if they won't manage the technicians or the sales reps or whatever it is, the business would crash. And it's I think that this is maybe one of the biggest bottlenecks for small businesses. And I'm wondering how you see it and how you see that the transition happen successfully, whether it's in terms of compensation, whether it's where you hire those skilled people to come for an operational role. How do you see the shift from being the owner operator into being basically the owner and visionary and maybe like title president of the company? Sure. We focus more on the strategic component of the business rather than the day-to-day operation.
So I think there are a lot of ways to answer this question. So one is we have a piece on our website called The Kingdom or the Crown. And we think that's a fairly good analogy when you're talking to somebody who has maintained a lot of control in the business. People have maintained control for a lot of reasons, some of which are incredibly valid. If it's your net worth that's tied up in the business, there's a natural inclination to control the environment and to control the outcome. And most entrepreneurs are pretty darn capable of doing a lot, right? So it's not that it's a bad decision at some scale of the organization to, carry the weight on your shoulders, as you put it, right? But the question is, is it more important that it's on your shoulders, or is it more important that you're building something that can last beyond you, right? And so that's the metaphor that we make on is it a kingdom that you are building that should last for successive generations, or do you just want to wear a crown and be in charge, right? And it's okay if you identify that you're just going to be in charge. March, but then you don't have a sellable business, right? Because you ostensibly at some point will leave. And so the business has to be manageable without you. So that's kind of the macro version I would give is the kingdom or the crown, because I think it's a good way of thinking about why you're doing what you're doing. But then on a day-to-day basis, obviously it's far more gradual in terms of how you make these decisions. I think what often happens is that somebody tries to make a key hire, and you mentioned compensation, which is a key component of this. They make their most expensive hire, right? A six-figure employee for the first time, as an example. And they have grand aspirations of what that person is going to be able to take off their plate personally and be able to do for building the business long term. And then it turns out that that person is not as great as what they would have expected, as big as their aspirations for them were. And they feel like they got gypped because it's now a really expensive person on the payroll if they keep them. Sometimes it doesn't even work out and they fire them. But if they keep them, then they're like, you know what? Well-paying employees aren't worth it. I'm going back to just hiring people who can do purely executional work, and I'm just going to stay in charge. And what I call that is like you've identified that you've got a problem, but you've identified it as the role and not the person, right? So maybe the role is still what you need, but you just hired the wrong person for that role. It doesn't mean that the role is invalid, but you've decided that because you already made the investment, you made the decision, and you don't want to take it back, right? And so this is actually a reason that we end up doing some deals, is that people have had bad experiences in trying to diversify their management team and add key people at, not insignificant compensation structures, and they just feel out of their depth. They feel like they get taken advantage of by some people, and then in other cases they feel like they hired but didn't get the skill sets or the capabilities that they thought when they did that. And so when you're making managerial hires, it can be helpful both for it to not be just your equity dollars that are paying for that person, right? So there's sort of a diversification of who wants to spend money on proactive hiring, which can be a reason why you bring on an investor. And then there's also, where do you go look for talent? And that's a big component, I think, of why some smaller companies partner with firms like ours, is to be able to attract people who may not go to a local business and just say, I want to be hired at a local business. But when that business is part of a larger network of opportunity and they feel like they can see a career path that is bigger in scale, you can attract some talent that you may not otherwise have access to, and design incentive structures that tie them to the growth of the business in really interesting ways. And so, there's a talent opportunity set that factors into this, because if you don't have anyone you can delegate to, then you are kind of stuck with everything being on your shoulders. And then once you have people in place that you can potentially delegate to, I think the final step is just figuring out, what do you want to work on and what do you want to do? And I have this conversation with almost anyone we potentially are going to do a deal with, but most entrepreneurs and most operators are like pretty passionate about work. They enjoy what they do. And when you've done something for 20 some odd years, like, it's kind of hard to rip yourself out of it. Some people are ready, but the vast majority are not. And instead, what's ended up happening is potentially like they've ended up with a bunch of admin work on their plate that they didn't ask for or didn't want in the beginning. Or their role has become murky because there's too much redundancy. And so they don't have like a true thing that they can own and drive the business forward with. So you end up in this like no man's land of just like a bunch of stuff on your plate, and you don't know what to do with it. And so, we have this conversation with our operators every 6 months on, what's on your plate that you actually enjoy, what's on your plate that you believe is materially driving the business forward, and what's on your plate that has to be done, but you don't enjoy doing, right? And then the natural steps are to get the stuff you don't enjoy but is important off your plate first, right? And then to figure out what of the things that like is an overlap on what you enjoy and what materially adds value to the business, and try and increase your focus and your time on those things, right? So for a lot of founders in particular, especially engineers by mindset or trade, you know, they're like product people, they're problem solvers, and the best version of themselves is not oftentimes leading the business. It is leading product or leading some element of manufacturing that is about advancing either, you know, the solutions they're creating or the process by which they're creating them, which is an incredibly vital role to growing the organization, but it's not necessarily like the CEO role, right? And so we have this conversation both pre and post close with a lot of people around just like, what do you want to do? And let's figure out how to, you know, hire for skill sets that solve for the things that you don't want to be doing. Make sure we do that stuff first and give you more time to focus on the things you do enjoy doing. And then, you know, over time, obviously the succession to that is making sure that we find people you enjoy spending time with who share similar skill sets that can be trained up and, you know, essentially like apprentice with you, so that long-term they can take over those responsibilities as well, so that you never feel beholden to the business. Because I think that's where, like, it's sure there's like a heavy burden in the crown, but the worst version is when you feel like you can't take it off. And so you've got to get to a point where you have people and have faith in those people that they can steward it without you. And that's a pretty important role that organizations like ours are involved in when we partner with businesses, you know, in that planning phase. And it's again why selling 100% on day one is a harder transaction for everybody involved.
Right. Yeah, and I think that ego is a big component of taking that crown, so to speak, for a lot of
for sure,
entrepreneurs. Yeah, and I think first of all, I think that. Sorry, go ahead.
No, I was just going to say, I mean, it always plays a role. But there's helpful ego, right? And then there's the version of ego that keeps you from moving forward. And when you are holding on to control for ego reasons, like that's not actually helping you. So it's a component that you have to gain some self-awareness around in order to be able to solve for it.
Definitely. And first of all, I think that, you know, going back for a second to that hire that, you know, you're bringing on your first six-figure hire and it's not successful. It's very easy for us as entrepreneurs saying, oh, is not as talented as I thought he is, or he can't do the things I can. But it oftentimes goes back to the SOPs and into the operation manual, and whether we're documenting everything that we're doing, that we can end off those specific tasks, you know, step by step. This is what needs to be done, and when you're the owner operator, a lot of it just sits here. And you're expecting someone who never been in your business, doesn't know the culture, doesn't know the vision, doesn't understand the employees. You expect them on day one to operate the way you do, and it's kind of unreasonable and almost delusional for it to happen. So I think that's
absolutely
another thing. Yeah.
It's the difference between technical.
No, go ahead. Sorry.
Well, I was going to say it's the difference between having a technical skill set and then, you know, institutional knowledge within a business, right? And this is the posture that we take around why we would never claim to know an industry or a position for a specific company better than the people who are dealing with it day to day, because the institutional knowledge in an organization is learned through experience. And so you always have to separate sort of what somebody's hard skills are and what their differentiated experience is when they come to the table from what you have, which is oftentimes for an owner, hard to appreciate because you've been in it for so long and it is your day to day. But I think it's absolutely an incredibly valuable point in the sense that like the institutional knowledge is what is invaluable in every organization. And the difference between a sellable business and an unsellable business is if that institutional knowledge only exists in the owner's head, right? And so if you can't teach it to someone who joins your business, you don't have a sellable business. And so it is an important part of thinking through your mentality as an owner. It's even beyond ego. It's just, if you can't articulate it to anybody, then no one else can make those decisions. We see this most commonly with people who make opportunistic purchasing decisions, and they'll say they buy it on instinct. And so, they're buying commodities and raw materials that change in price quite frequently, and they make high conviction, high volume purchases at various points in the year. And you're like, how did you make that decision? And they just say, I just know when to buy. And it's like, well, that's not teachable, right? And the conditions will consistently change. And so unless that can be articulated in a way that makes it transferable, we have a problem, right? And those are the types of things where you've got to be able to figure out, like, okay, why is my gut telling me that? Why am I making that decision? And it takes a fair amount of introspection, but it's completely worthwhile as an owner to your point, document it at some level, but really figure out, why am I making the decisions that I am, so that I can make them teachable to somebody else.
Absolutely. And the second thing is that I wanted to see if you can give out like specific example of compensation and incentives, because I know we talked about obviously like a 6-figure, like the monetary compensation is one part, but I don't know if you saw that tying your success to increase in revenue or different type of incentives and compensation for managerial roles. Do you see something that works better again for the entrepreneurs who's going to make their first time like big hire or managerial hire?
Sure. Yeah. So I would say that most often what we see in service-based businesses specifically is if they're divisionally responsible for something, their incentive compensation is tied to the gross margin associated with that division. And that becomes kind of a key component. So if they're running your remodel division, as an example, it would be, the revenue and then margin dollars produced out of that. And we are big advocates that it should be based on margin as opposed to top line revenue, because people can make interesting decisions to push revenue through that may ultimately either be short term in nature or negotiated in such a way that it's below your margin target, right? And therefore is, creating activity, but not necessarily profitability for the organization. So that's divisional. If you're hiring somebody in like a chief operating role, what tends to be a good way to think about it is, how do you make sure that they're competitively compensated in a salary, but keep that in such a way that you can provide for meaningful incentive compensation tied to the growth of the organization. And so sometimes that is a percentage of the net income of the organization. Sometimes that's another target, depending on what you're trying to optimize for the business for at that point in time. And it can also be a multi-year target. So you can have deferred compensation structures and some other things that, encourage them to help the team. So this is true, like even beyond a chief operating officer, if you have somebody who's responsible as like the head salesperson, who's also supposed to help all the other salespeople, when you have someone who's in that role, there can be a tendency for them to keep revenue that honestly should be delegated to somebody else, because if they're only
Keep all the good sales calls
incentivized
for
off of their own
themselves.
book, Yeah. It works against you, right? So tying deferred compensation measures to, kind of aggregate goals or team goals can be really helpful as well. So I don't have like a specific, this is exactly the percentage of each thing that you should do, because I think it depends on the scale of the business, the sophistication of who you're hiring, and your expectations on how the business should grow. But I think that anytime you're making a hire for somebody who is in a managerial role, if you're growing a business, you want to tie their compensation in some way to that growth, right? And you want them to have high conviction about that. So if they say, sorry, I want more base compensation and less of that incentive, I think that creates a very productive conversation around, why is that the case? Do you not believe that we're capable of these things? Or do you think there's an impediment either around your skill set or our market potential that we should discuss before hiring you for this position? And I think that, it leads to, because there can be reasonable reasons sometimes why they want to hire base. And that may be based on market or specific life circumstances or whatever it may be. So sometimes it's valid, but it is an indication that if they're not in it to see the business grow, then you may have a challenge. And then the final piece is, like, if you do intend to sell the business, there can be reasons why you put something in place around certain both scale achievements and then also, some sort of carrot around the business being sold, or at least doing a deal of some kind. And my caution on that is, when you have a key employee, if that person is supposed to stay with the business, if they're provided with a big liquidity event that just sort of ends at the point of transaction, it creates instability in the relationship between the new owner and that individual, right? So it's something that you have to disclose to the potential buyer, number one, so that they're aware of it. But it's one of those things that you end up having lots of discussions about around, okay, so do we expect this person to stay or not now, right? What we tend to find can be a really good alternative to that is something by which there will be a carrot for them, but it potentially gives them the ability to roll that forward as equity in the new business or something along those lines. And again, that would be for like a chief operating officer or somebody who would normally buy into the business if they were going to be your partner long term. So there are a bunch of different ways to do it, but yeah, I would say incenting them on growth in some way and making sure that it's aligned with profitability and scaling profitability and not top line is the most important component.
Yeah, I think that, I mentioned earlier that your podcast and the messy marketplace is one of those things that every entrepreneur need to listen to. And I think that also Built to Sell, like it's a great book for people and entrepreneurs to learn and understand how to build their organization. Built to Sell and also the E-Myth, obviously. So those two books are must. I'm wondering if you have some recommendations on books, on workshops, on master classes, whatever it is for the business owners who wanna become better themselves, who wanna improve their skill sets as managers, because we might be the best technicians in the world, but when it comes to business owners, a lot of the times we're not that good, and it takes a lot of humility to admit it. But we need to grow, and I feel as a coach myself, and as someone who's joining numerous coaching programs, that learning from others who went through the path that you're on right now and been through what you're going through right now is the best way to do it. So I'm wondering if from companies that you've invested in, if they're members of specific clubs, or if there are workshops, or
sure.
like any material that will help the
just any recommendations
or listening to this. Yeah,
sure. Okay, so I'll run through a list because I've got plenty of these. So first would be, we do regularly publish on our site. And we have a newsletter that is called the Permanent Playbook, and it's specifically intended for operators of businesses. And we send an email every 2 to 3 weeks, but they're thematically based. So it's either on hiring or some sort of operational philosophy, and within it is something original that we've created for the benefit of the operator, but then also other resources that have inspired us. So whether those be, HBS case studies or a YouTube video or whatever it may be. So I would encourage people to subscribe to the Permanent Playbook newsletter, which is on permanentequity.com. I would say that for owners specifically, there are a couple of books and one of which I'm just now finishing, but I think will be on my list long term as well. So the one that I normally recommend people look into is called Glass House. And it's written by a journalist, and it is absolutely one-sided in terms of the author's perspective on what happened. And I don't agree with all the conclusions that he drew within the book, but it is the story about a factory town in Lancaster, Ohio, and a business that was owned by an individual who just wanted to retire and move to Florida. Nothing malicious, nothing consequential. He was of the appropriate age. But he picked a suitor to sell to that then successively sold the business every 3 years over a period of, I believe, 15 years. And this journalist went back because he was from the area and just walked through his experience from having been a child in the area to now being, now still having friends and family in the area, but no longer living there, and coming back as a journalist and just being absolutely offended by the state of affairs, right? Where leadership all lives out of town. The business now employs a fraction of the employee base it used to. The town in general has become downtrodden. And again, he's drawing some conclusions that I think are somewhat emotionally charged, but it's a warning bell for any owner about how to think about how to choose a suitor, in my opinion. So it's a book that I think is important in that regard. And then the next one, which just came out, but is really quite good, is Power Failure. So it's on GE. And so it's Jack Welch versus Jeff Immelt, and it's written from a third party point of view. And he is really talking through, Jack's perspective on what he thought he left in the business to his successor, and then how that was stewarded forward, and really drawing criticisms on both sides about what was the state of affairs and what should you expect of the future generations in terms of stewardship. And I think it would lead to some really interesting conversations for an owner on, how do I think about what post-close life looks like, particularly in the sense of, like, we always try to avoid people having seller's remorse, right? And being mad if the business does better when they are no longer involved. I think that's a really big challenge culturally, and it's a really big challenge for obviously the individuals involved. And so in that way, that's something that we proactively like to have conversations about with anybody who's involved in a deal with us. So that book for me has generated a lot of thoughts around, what was each gentleman's intent and perspective and posture as that transition took place, and then obviously what's happened to GE over the period since, and trying to think through how could things have turned out better. So those are two books I would recommend for owners. In terms of, organizations and membership opportunities, I think there are increasingly a wide variety of things that people can join and belong to, that give them different versions of, think tanks, if you will, and peer groups. So, obviously there's EO, Entrepreneurs Organization. There's the EOS system has created quite a network around theirs. There's Tugboat for people who believe in, maintaining continuity and family involvement for as long as possible. And so those are, without industry affiliation, those are some of the groups that come top of mind. If you want to get to know sort of advisors and more traditional investors and financiers of varying types. Association of Corporate Growth is another one. So they have, local chapters in most major cities. And that's another place that you can go and spend time. And they have operator tracks as well. So it can be for owners, but also for operators. So those are a variety of like the ones that come top to mind. But I would say that, the other thing that we're trying to do to advance this is bring down the professionalism layer a little bit and allow people to get to know each other as people. And we started experimenting with this first among investors only. So you can imagine, what people think of as an investor conference is a lot of people in suits. And our experience is that most investment conferences are a lot of people in suits, and and it's not very fun. And it's pretty stuffy. So we started an event called Capital Camp in 2019 that's held annually, where we bring people together in an incredibly informal setting, in shorts and flip-flops kind of attire, to have shared experience, eat a lot of really good food, and just fellowship, right? Get to know each other. So we are doing that for the first time for a non-investor community, and instead for the broader community of smaller companies, small to mid-sized companies is the way we're phrasing it. And we're calling that Main Street Summit. And so Main Street Summit will be an in-person event held this November with the intention of it being an annual event to go on in the future. And it has kind of a South by Southwest kind of feel to it. So there will be a large variety of events going on all over town. The nice part is our town is used to hosting festivals. So we have a variety of venues that convert themselves nicely for use for a variety of purposes. And we're going to do 2.5 days of people just coming together around small businesses. And so all different types of operations, all different types of challenges that you may be encountering, and really having workshops and discussions and think groups around those things, and in a variety of different industries as well. So I would encourage people to look into that. I think there's already about 1,000 people on the waiting list for it. So it should be a pretty sizable event, and tickets are going to go on sale in June. But those are all things that I think of when I think of like, how do you make recommendations? It's like, you want real information, right? You want real encounters, and people who are not trying to sell you things, but are instead saying, you know what, I'm dealing with similar stuff, and let's talk through what's worked for you and what's worked for me. And I think that that's most often or best done oftentimes in person. And so I would encourage people to seek out the events both within their industry and things like Main Street Summit, to be able to come together in, just a day or two, to really talk through those things and find some relationships that they can continue to foster over the long term.
Emily, I love what you guys are doing. You guys are really transforming in a way like private equity, and in every sense, like you can think of, from the accessibility, from the knowledge, from the like you said, like down to earth events, and not having caviar and just 3-piece suits. And I absolutely love it, and I think that you guys are doing amazing job. Closing note, I want to hear your thought on ChatGPT AI and how you see it play out in the service world, and how, like, if you're already seeing how it transforms some of the industries and the companies you're working with.
Sure. So I won't take credit for this, but Brent and then Mark Brooks, one of our other partners, really have been leading the effort internally on this front. And the way that we've been talking about it internally is thinking about AI as like your new entry-level employee. And so you really don't know long-term what the potential of it is. But you need to start throwing things at it, see how it handles those things, see what you get back, and then continue to train it with the intent that as you continue to train it, you're going to find things that it's better at or worse at, and obviously trend towards the things that it's better at. And so with that, like, we created a playground internally on Slack where we're just kind of, it's called AI Playground, and it's just people submitting like, hey, I did this with Bard, or I did this with ChatGPT, and this is what I got back, when it's successful, so that everyone's aware, like, it worked for this thing, right? And then someone else can come back and say, well, I just tried it on a different platform and I got this answer, which seems better or worse, right? And go forward from there. So we're in the point where I would say we're treating it like a playground. We're just testing a lot of things and trying to train it and see what it's capable of doing. It was funny last night, one of my other colleagues, Danny, put something in trying to get a result of businesses back, and one of the platforms he used gave him a list of 10 businesses, all of which were fictitious, didn't exist, and they had like long descriptions, and it just made the whole thing up, and he was so disappointed, and so he put that in. And he was like, well, this didn't work because none of this information is factual, and so, you know, I don't think it's in any way fail safe at this point, but it's fun to experiment with, and we think the long-term implications could be quite powerful for smaller companies if you think about it with that mentality. Obviously, if you think about it as a broader threat, I think, you know, it can seem intimidating and potentially like it will be a problem. But our experience is that, you know, it's very far away from being, better than most of the systems and people in place now. And that, you know, properly trained, it can be a huge booster to productivity in the long term. So we're excited about it, but kind of messing around with it, I would say, for the time being.
Yeah, and I know this from, you know, the coronavirus area, when, you know, when it just started. I was just going into this rabbit hole of like, you know, like everything that's gonna go on with the World Economic Forum and everything is just like, it's mind blowing, and you're just getting all depressed and stuff. And I'm like, okay, I understand the big picture. There's no reason to really just get into it too deeply, because whatever happens ends up happening. And so I come with the same mentality, and this is, by the way I teach like our students is like, okay, if AI, you know, as some predict, is going to ruin all over, run the world and ruin everything, okay, what can we do about it? Not much. But on the contrary, let's see how we can utilize it. Let's see how we can work with it. Let's see how we can take advantage of this new technology. And so we're seeing. By the way, I posted this new guide on how to work with prompts that help home service businesses, whether it's getting keyword ideas or different prompts to help them respond to Google business profile reviews and different things, that it's a useful tool, and we're only at the beginning of it. And like you said, it's time for us to basically treat it as a new virtual assistant, as a new entity inside of our business. And with time, as we train ourselves on working with computer and communicating with computers in that sense, where it's not just you're looking for a restaurant near me, but it's more of a conversational manner.
Right.
We will see amazing results, and really it has the potential to really expand and grow our businesses. Emily, I want to thank you so much for doing this. This has been so insightful for me, and I'm sure for a lot of our listeners. We will integrate the links to the event and to the podcast in the description below. And that's it. I just want to again thank you for taking the time, and see if you have any last words for our listeners.
Yeah, no, I really appreciate it. This was a lot of fun. I'm pretty easily reached via email or Twitter. So encourage people to reach out if they have follow-up questions. And yeah, I appreciate you reaching out, Laura. This was fun.
Amazing. Thank you, guys. Make sure to like and subscribe to our channel. And we'll see you guys here in the next one. Peace.